So again, what do banks care most about? Well, number one, they're always going to look at the credit worthiness of the borrower. And in many cases, especially today's world, they're going to ask you to sign personally on any deal. So if the deal can't work on its own and they need money to keep the deal afloat, they're going to look to each of the individual investors to kick in. Another item we mentioned earlier is the size of the down payment. Typically with residential, you're looking at 20 to 25%. Commercial, you're looking at 25 to 35%. Again, they're looking at DSCR, that ratio, to make sure that there's enough income to comfortably cover the debt. Okay, this is not something that they're going to hedge on. Banks do not want to own your real estate. So even though they can take over if you fail to make payments, the bank is in the banking business. They're not in the real estate business. So they're going to make sure that everything's very conservatively done so that even if there's a vacancy and you're assuming you're at 90% right now and you fall to 70%, that the building can make sure they can comfortably cover the debt service. So they're going to look at stress testing the deal to make sure that it's not too risky, because we don't live in a perfect world and deals don't go perfectly all the time. Appraisals and market comparabilities are going to be important. And then the reserves. Banks often want cash reserves equal to several months of payments. So when you do a deal with a bank, even if it's a different bank than you normally bank at, they're going to have you open up an account and make sure that you have deposits with that institution. So if there is a shortfall, that there's money there to keep everything current with the debt servicing. So if you're serious about investing, learn to think like a banker. You have to approach it from their standpoint because you're asking them for money, right? Think about if your friend comes and asks you for money. Yes, out of your friendship, you might have a bleeding heart. You might want to offer them money. But if you know you're dealing with someone who's not very stable, can barely keep a job, are you looking to lend your friend money? So now the banker is in business. They have shareholders and other, all their customers to be responsible for. So the bank is going to take this very seriously and look at making sure that you have stable income streams, that your leverage, whatever it is conservative, and that the assumptions used when you go to sell the deal to the bank and you go to ask them for a loan, that the assumptions are very realistic.